Buy-to-let in London is completely dead in the water. In this video, I'm going to share with you 10 reasons why I believe that's firmly the case. Whether you're thinking about doing buy-to-let in London after watching this video, you certainly won't want to do it. You'll choose other areas of property to invest in. And if you have buy-to-let property in London after watching this video, you may consider selling some of those property assets and doing other things in property with the proceeds. If you're new to this channel, make sure you subscribe and hit the bell icon. We're at 71,000 subscribers now, and that means the more subscribers we get, the more YouTube promotes our videos, the more likes and comments and views we get, the more we can put into making more content like this and delivering it to you. At the moment, we're giving you guys 4 YouTube releases each and every week, all dedicated to keeping you on top of your property investing game. So smash that like button, share, and also comment, and don't forget to subscribe. So reason 1 why buy-to-let is dead in London, that is the 3% SDLT surcharge. Now, this was brought in by the Conservatives because the logic was that landlords were hoovering up first-time buyer property and taking them away from owner-occupiers. Well, the real problem was the planning system was crap and properties weren't being built, and supply and new house building was woefully inadequate. But it's easy to blame the landlord, which is what they did. So what they said was that if you're buying a second property, or you're buying a property within a company, or you're buying a property as a buy-to-let investment, then on top of the usual stamp duty, you pay a 3% surcharge. So in London, according to Rightmove, the average home is valued at £750,000. So if you're paying stamp duty on that, plus the additional 3% surcharge, that is a whopping £45,500 just in SDLT. And remember, when you get a mortgage on a property, you get a mortgage based on the value of the property. You can't borrow for stuff like stamp duty. So you've got to find that real hard cash to pay the huge stamp duty levies charged on London property in particular. And of course, when you get a buy-to-let mortgage, you've got to put down 25% deposit. So on a typical London property average value of about £750,000, that represents about £187,000 as a deposit. Coupled with the stamp duty, that's 233 grand of cash just to buy a typical London buy-to-let property. This 3% additional surcharge on stamp duty alone has been, in my view, the #1 reason why rental housing stock in high value areas have fallen to such lows. Now, reason number 2 why buy-to-let is dead in the water in London is that London is one of these international cities. We all know that. When you check into any hotel around the world and you see the clocks that are behind the receptionist in the hotel lobby, they will say London, New York, Tokyo. You know, you'll never see Birmingham or Manchester represented on one of those clocks. It's always London. London is a global city, and as such, it attracts people looking to invest in property from all over the world. But the government have had other ideas on foreigners buying up London housing stock, and they put in extra stamp duty charges on foreign buyers. So I've got on screen here the stamp duty paid by UK residents and non-residents. So you can see that already non-residents pay a lot more stamp duty. Now, because London house prices are higher, it disproportionately affects the London housing market. Now, the thing is, Labour have said they want to increase the amount that non-residents pay in terms of stamp duty. So these rates are going to go up even further. So this is obviously going to affect the London market. It won't affect London prime. You know, those super wealthy people purchasing £5 million plus properties in Chelsea and Hyde Park Corner and all of that sort of stuff. It won't really affect that end of the market. But a lot of the lower end of the market, the sub £2 million market, will be affected by pretty much a drying up, I think, of foreign non-resident UK house buyers. So the third reason why buy-to-let is dead in London is because pretty much the rental yields are pretty rubbish in London compared to the rest of the country. Now, I mentioned that the average house price in London is £750,000. The average house price everywhere else outside of London is £290,000. So London properties are more than double. But the thing is, London rents ain't more than double than other parts of the country. Now, I've got some data from Rightmove. It's slightly different data to the house price information. It looks at property rents outside of London and particularly within Greater London. And you can see that there is a difference, but the difference in rents that you get from having a high value London property doesn't really reflect the extra costs you're having to bear for having to buy the property in the first place. You can also see that outside of London, the rate of growth in rents is higher than in London. And what we're really seeing there is the fact that rents in London are pretty much at the maximum share of a tenant's wallet that basically is affordable. So what all that means is the rental yields or the returns that you'll make from London property is less. And of course, if you've got a far greater capital outlay in terms of deposit and stamp duty, upfront stamp duty to pay, it simply isn't worth it. You can get better buy-to-let returns in other parts of the country. Reason 4 why buy-to-let is dead in the water in London is the good old Section 24 tax on mortgage interest payments, which George Osborne brought in 2015. Now, when he brought this in 2015, interest rates were at record lows, and arguably it didn't really matter too much to a lot of people at that time. But now, of course, interest rates are much higher. And because it's a tax that people pay on properties they own in their own name, depending on the amount of mortgage interest they pay each year, it disproportionately affects London property investors because they tend to have larger sums owed on buy-to-let properties. Now, the other thing which disproportionately affects London investors is that there are a lot of properties in London, buy-to-let properties, which are owned by unincorporated individuals. In other words, private individuals that basically once lived in those properties and later on decided to rent them out and moved outside of town. This used to be very common. People in their early part of their lives used to live in London, they used to buy flats and things, and then later on they'll get married or have families, they'd move to the suburbs, but they'd retain their property as a buy-to-let investment. So they never intended to do it as a business like you or I, they never intended to be a serial buy-to-let investor, they just have one or two properties by accident, which they've kept as an investment or as a pension, and they've kept in private individual ownership. Now, there are disproportionately more of these people in London than in other parts of the country, and these people are affected massively by the Section 24 tax. Now, unlike professional buy-to-let landlords who have multiple properties and are doing it as a business and who can incorporate their property portfolio into a limited company, smaller landlords, accidental landlords, hobbyist landlords, or people that just have one or two as a pension, they can't do that. So they have to bear the full brunt of the Section 24 tax. And this brings us pretty much to number 5 reason why buy-to-let is unviable, is that many landlords in London, particularly those who are affected by Section 24 tax, find that they're barely breaking even on their buy-to-let property. What's the point in dealing with maintenance and leaky taps and legislation and all the rest of it if you're barely breaking even? Now, here's a couple of other things that you may not have thought about. In London, management costs or property management costs are higher. So if you hire a letting agent to let and manage your property, they're going to charge you a couple more percent than they will do in outside of London areas. It just tends to be that way because the costs of running a business are higher in London areas. Now, many buy-to-let investors also go for fixed rate loans. So you might have fixed your mortgage rates for 3 or 5 years. Now, as you come out of those fixed rates, you then have to take up another mortgage, take up another fixed rate product. What the mortgage companies are doing increasingly is charging whacking great fees, admin fees, loan arrangement fees, just for securing a buy-to-let mortgage. So this is not very good. So if you've got a loan, say, on a London property of £500,000 and your lender is charging you 5% and as an arrangement fee for securing that 500k loan, and you might just have a fixed rate for 3 years, then that ain't good news at all. Because remember, in the last 10 years, London prices haven't really gone up that much. It's pretty much near stagnant. So here's the thing. If you have to take out a fixed rate mortgage and you have to pay a 5% arrangement fee on it, and it's just a 3-year fix, then at the end of that 3-year fix, you're going to have to remortgage again. Now, this fee that you have to pay, this 5%, is added to the loan. So if house prices haven't gone up by the amount of that fee in 3 years when it comes to remortgage, then you might have difficulty. So you've got to have a serious think about the medium-term outlook for London prices and think, well, okay, if I pay for these arrangement fees, is it actually going to stack? Because of the lower rental yields in London and because interest rates have gone up in recent years, if you are remortgaging a loan which you originally got at, say, 70% loan to value or what have you, the only way you will be able to remortgage without having to put in cash injection will be to accept these higher arrangement fees from the lender. I know mortgage rates are likely to come down in August and there may be another small drop towards the end of the year, but that won't be enough to solve the issues that I'm talking about. So have you got buy-to-let property in London? Are you thinking of selling up? Are you thinking of buying more in London? Let me know in the comments below. I'd love to know what you're doing with your London buy-to-let portfolio. The sixth reason why buy-to-let is dead in the water in London is those money-grabbing councils. A lot of London councils are near bankrupt. They don't have a bean. They are seeing landlords as a bit of a cash cow. We've long had HMO licensing, but more and more councils in London are seeking to do additional or selective licensing schemes. Now, what that means is it doesn't necessarily have to be an HMO. Even if it's a 2-bedroom flat, occupied by 2 or more people, then they want you to have a license. And what that means is coughing up a fee for a 5-year license. It's typically £1,000 plus for that license. And what do you get for it? Sweet FA. Reason 7 why buy-to-let is dead in the water in London is the growth outlook for London prices over the next few years. Now, when I started buying buy-to-let property in London way back in the 1990s, the main return that you could look forward to was capital growth. Yes, there was a rental income and there was a rental yield that made it worthwhile, but the main thing was the capital growth prospects of London property, which for many decades far outstripped other parts of the country. And that huge capital growth made it more than worthwhile. But when you look at London house prices since Brexit, you'll see that they haven't really moved up at all. If you look at house prices in London over the last 30 years, most of the growth, the explosive growth, has happened in the first 20 years. Not much has happened in the last 10. In fact, last year, London house price growth was just 0.6%. So with many London landlords choosing to sell up, with the issue of higher SDLT for non-resident buyers, meaning that a lot of the foreign market for London property will diminish, and of course higher mortgage affordability costs for higher house prices in London, I'm not really convinced that over the next 5 years we're going to see that much capital growth in London property values. So if your rental yields are lower than other parts of the country, if you're barely breaking even or making a small loss on your buy-to-let property in London, thanks to Section 24 and other costs going up, if the medium-term outlook is minimal, bumping along stagnant growth in prices, then you've got to ask, what's the point in keeping a buy-to-let property in London? Of course, I'd love to know what you think. Do you think London buy-to-let property is just a good store of wealth? Or are you thinking you can get better return on your investment elsewhere? The eighth reason why London buy-to-let is dead in the water is the return on equity dilemma. Now, as I said before, since Brexit, there's been very little new buy-to-let investment in London. The rental housing stock ever since Brexit has kept going down year on year, which means many of the landlords who own buy-to-let property in London have owned those properties for 10 plus years. The longer you have owned a buy-to-let property in London, the more you have to consider whether the return on the equity that you got tied up in that property is actually sensible. Now, what do I mean by that? Let's say you bought a property 20 years ago. You bought that property for £250,000. Today it's worth £600,000. If you haven't remortgaged that property, you've then got quite a lot of equity tied up in that property. Now, if you take the view that most of that capital growth has happened, and over the next 5-6 years it's unlikely to go up that much more, then you have to ask yourself, well, if I then sell that property and release that equity, can I deploy that equity elsewhere and get a better return for it? The thing is, many landlords are reaching the conclusion that the return on the equity they're getting is just not worth it. And then we come on to reason 9 why buy-to-let is dead in the water, and the reason why the rate of people looking to sell London property is accelerating. And that's because with the new Labour government, it's widely expected there are going to be increases in capital gains taxes for buy-to-let investors and second homeowners. Now, remember, we already have 2 different rates for capital gains tax. If you're an entrepreneur or have shares in a business or a trading business or whatever, you're charged capital gains tax at one rate. But if you have a letting property and investment property, then you're charged capital gains tax at a higher rate, if of course you own that as a private individual. So they already treat property separately. What a lot of people are worried about is that they increase the CGT on property disposals from 28% to a higher rate. And that's because at the end of the day, the Labour government is a socialist government. They don't like the ownership of property for rental. It's something Labour and socialists are ideologically opposed to. They see that any profits made from getting rent as basically not being real earned money. That's the bottom line here. And that's why they are likely to tax that at a higher rate. Now, the first Labour budget is going to be in September, so a lot of landlords are wondering, well, if I own properties in my own name, I'm affected by Section 24, I've got all these sort of issues, I don't really see that much capital gain going forward. If I cash in my chips now, then I'll be paying the current rate of capital gains tax, not what could happen in September, and then I'll have more money released, more equity released, to then redeploy elsewhere. Now, the 10th reason why buy-to-let is dead in the water in London is because so many landlords, particularly smaller landlords, fear the abolition of Section 21. Section 21 is a notice you can give to your tenant which basically requires them to leave at the end of the tenancy, and you just have to give them 2 months' notice. And you can do this for any reason. Now, I don't see what's wrong with this. If it's a 1-year tenancy and it's a 1-year tenancy from the outset, and you give notice at the end of the tenancy that you just want it to be a year, what's wrong with that? Everyone knows where they stand. The new Labour government want to do away with this Section 21, which means that the tenant have to have committed a breach of contract for you to then go to court to get them out of the property. So remember what I said early on in this video, many London landlords only have 1 or 2 properties. It was probably a property that they once lived in. They're more emotionally attached to it, and the last thing they want, and something they'll be fearful of, is the inability to get the property back. Now, one of the most depressing things about Labour's proposals to abolish Section 21 is that they won't even take into account the fact that the landlord wants to sell the property as a ground for eviction. To sum up then, I see no business case for investing in buy-to-let property in London. It's simply the figures are against you and the rules are against you. It doesn't really work. If you've already owned buy-to-let property in London, there's a serious case to look at each property on a case-by-case basis and deciding whether it's worth holding or selling. Despite various government rule changes, buy-to-let is certainly alive, and there are parts of the country and there are ways of doing it which can achieve real returns if done as a proper business. And in a future video, I'm going to share with you my guide for not just surviving in buy-to-let through a Labour government, but thriving. That's all coming up. Don't forget to like and subscribe, hit the bell icon, also comment. Tell me what you think in the comments below. See you guys next time. The Baker Street Property Meet is the UK's largest and #1 property investors networking event. The property market is going through monumental change right now, and at Baker Street Property Meet we aim to keep you up to date with the latest tips and tricks and insider tactics to help you keep on top of your property investing game and succeed in these troubled economic times. The Baker Street Property Meet is fundamentally about networking, because it's not what you know, it's who you know. And at Baker Street, we aim to connect you with the people to make your property journey a monumental success. There's no better place to be to further your property investment journey than the Baker Street Property Meet. So make sure you're here, you're connecting with myself and Andrew Roberts, our expert guest speakers, and 300 passionate property people each and every month. See you at the next meet. Get your spot at bakerstreetpropertymeet.com.